Ever watch The Wolf of Wall Street and get, well, kind of sucked in by those scenes where Jordan Belfort, or, Leonardo DiCaprio is suddenly like rolling in cash? I mean, it's the stock market, but still, it's just wild to see that kind of fortune just appear out of nowhere, right?
Oh, yeah, totally. It's incredibly captivating, but
So today, on this deep dive, we're going deep, like really deep, into how Belfort actually did it. But, and this is the part that matters to you listening, like, could any of that even remotely work today in 2025? Like, could you pull a Wolf of Wall Street and just, I don't know, become a millionaire overnight?
well, that's what we're going to find out, right?
Exactly.
We've got a ton of fascinating stuff to dig into, analyses of the movie, FAQs, even some study guides, the whole 9 yards, really. And the point is, we want to go beyond the Hollywood glitz and glam, and really get down to the nuts and bolts. How did Belfort's strategies actually work? And more importantly, how do those tactics stack up against the real deal, ethical ways to build wealth, the kind of strategies that, you can actually use today?
Right, because this isn't just about a movie. It's about figuring out what works and what to avoid in the real world, in the markets today.
Exactly.
So, all right, let's break this down. When we see Belfort in the movie raking in millions, what was the fundamental engine behind all that wealth? It's flashy on screen, but how do you actually make the money?
Well, the core of it, according to all our sources, was this thing called the pump and dump scheme. Now, Belfort's firm, Stratton Oakmont, they weren't exactly looking for solid long-term investment.
No, they were not.
Their game was penny stocks.
Yeah.
Those super low-priced stocks that don't trade a whole lot?
Penny stocks, okay. So they load up on these cheap shares. What's the next step? How do they spin that into a fortune?
That's where the pump comes in.
Uh-huh.
Stratton Oakmont would launch this super aggressive campaign to drum up artificial demand for these stocks. So they'd use misleading positive information, think like really hyped up claims, sometimes straight up false stuff, and they'd spread it everywhere. Newsletters, those early online chat rooms, even direct mail. It was all part of the game plan.
So they're basically manufacturing hype around these, normally pretty dull stocks to get everyone else jumping in and buying.
Exactly. Create this sense of urgency, make people think they gotta buy now. And as more and more people bought in, based on all this manufactured excitement, well, the price of the stock would go up. That's a pump in action. Then once the price was high enough for their liking, Belfort and his crew would sell off their shares for a huge profit. That's the dump.
Gotcha. So they cash out. Well, everyone who bought into the hype, they're left holding these overpriced shares, which are, now plummeting? It sounds, pretty shady.
Oh, it was way beyond shady.
No.
It was completely illegal. And the scale of it was enormous. Investopedia points out that Stratton Oakmont was involved in, get this, the IPOs of 3 dozen companies.
Wow.
Including, Steve Madden, the shoe brand.
Yeah, yeah.
And they're estimated to have defrauded investors out of $200 million.
200 million.
200 million.
Yeah.
Also, the atmosphere inside Stratton Oakmont, it was a key part of the whole thing. Super high pressure, a real boiler room environment. They used these really aggressive sales tactics to basically strong-arm people, a lot of times unsophisticated investors, into buying this inflated stock.
Boiler room. Yeah, that paints a picture. Just constant phone calls, pressure, pressure, pressure. Sounds like they were really, exploiting people.
They were, yeah, the whole operation was designed to make Belfort and his firm rich at the expense of everyday investors.
Okay, so we get how he made his money, this illegal pump and dump scheme.
Yeah.
But the big question for you listening is, could someone actually pull off those same Wolf of Wall Street tactics in 2025? Is that even remotely possible?
Honestly, based on everything we've looked at, the answer's a hard no. The financial world, it's a whole different ballgame now than it was back then. Trying a scheme like that today would be unbelievably risky and honestly almost certainly a flop.
So what's changed? What are the big differences that make that kind of operation, not just harder, but maybe even impossible now?
Well, there are several major factors. First off, the regulations are way, way stricter now. The SEC, the Securities and Exchange Commission, and FINRA, the Financial Industry Regulatory Authority, they've really clamped down on market manipulation, especially the kind of penny stock stuff that Stratton Oakmont was all about.
Makes sense.
They're watching everything so much more closely now. And the penalties for these kinds of scams, forget about it, they are huge. Hefty fines. You could even end up in jail. Remember those news stories a while back about people getting charged?
Oh, yeah.
For pulling similar schemes?
So the regulators, they're more vigilant now, and they've got more power to, really come down on you.
Absolutely. They're actively hunting this stuff down. And then there's the fact that, well, investors today, they're just way more informed, way more savvy.
Yeah.
The internet has changed everything. People have access to tons of financial education, real-time information. They can research companies, compare investments, get independent analysis. It's not like the old days where you just had to take a slick salesperson's word for it.
Right. You're not stuck relying on some, fast-talking guy on the phone. You've got the whole internet at your disposal.
Exactly.
That's a good point.
And that brings us to the third big change, technology itself. We've got these incredibly powerful data analytics tools now. They can spot unusual trading patterns and suspicious price movements in a flash. Algorithms can flag potential market manipulation in ways that were just, unimaginable back then.
So the same technology that, makes investing easier for us, it also gives regulators these powerful tools to catch the bad guys.
It's a double-edged sword, for sure, but definitely in a good way.
Right.
And then, on top of all that, there's just way more scrutiny now across all sorts of assets, even in areas like cryptocurrencies, where there have been a lot of pump and dumps. Regulators like the CFTC, the Commodity Futures Trading Commission, they're getting serious. They've got whistleblower programs now to encourage people to report shady stuff.
Whistleblowers, that's interesting.
It shows you how much things have changed. There's this, broader, more proactive approach to shutting down these schemes across the board. And you can see it everywhere. Like on websites like investor.gov, they lay it all out.
So it's not just a U.S. thing, is it? Are other countries cracking down too?
Oh yeah, for sure. Globally, regulators are getting tougher. For example, India's SEBI, their version of the SEC, has been going after misleading financial advice from, those finfluencers we hear so much about, especially the ones promoting pump and dumps. So yeah, it's an international effort. These schemes have nowhere to hide.
Okay, so Belfort's methods. Not only will they land you in hot water legally, but they're also basically a guaranteed way to not get rich in 2025. So for someone listening right now who wants to build wealth the right way, ethically, through the stock market, what are the proven strategies? What should they be focusing on?
The good news is there are some really solid ethical strategies that have worked for a long time. Strategies that are all about sustainable long-term growth.
Okay, good.
One of the most basic approaches is just good old-fashioned long-term investing, the buy and hold strategy.
Buy and hold, yeah.
It's simple, really. You buy stocks in strong companies with a good future, and you hold on to those shares for years, even decades.
You're playing the long game.
Exactly. You ride out the ups and downs and let the company grow. And if they pay dividends, well, that's even better. You're essentially owning a piece of that business, sharing in its success.
So instead of trying to get rich quick by gambling on some hyped up stock, you're investing in established businesses that have a track record, businesses with real potential for the long haul.
Exactly.
I like it.
And another key strategy is diversification. Instead of putting all your eggs in one basket, you spread your investments around. Different sectors, industries, even different types of assets. And one of the best ways to do that is through index funds or ETFs, exchange-traded funds.
Right. Index funds, ETFs, we hear those terms a lot. What makes them so good for building wealth?
Well, they're a cheap and easy way to get a lot of diversification. Like an index fund might track an index, like the S&P 500,
Okay, yeah.
which includes a bunch of big U.S. companies.
Right.
So by investing in that fund, you're instantly invested in hundreds of different companies, which, reduces your risk way more than if you were just holding a few individual stocks.
Yeah.
And get this, over the long term, index investing often beats those fancy, actively managed funds. And you can get started with, not a lot of money.
So it's accessible, it spreads your risk, and it's got a good track record. Sounds like a win-win-win.
Pretty much. And there's another ethical strategy that can really help build wealth over time, and it's called dollar cost averaging.
Dollar cost averaging, okay. Tell me more.
So the idea is you invest a fixed amount of money regularly, like say $100 every month, no matter what the market's doing. So when prices are down, your money buys more shares, and when they're up, it buys fewer.
Okay.
But the effect is you're averaging out your purchase price over time. And it takes the guesswork out of trying to time the market, which, almost nobody can do consistently.
That's smart. You're taking the emotion out of it. Just consistently investing. Discipline.
Discipline, exactly. It's a great way to smooth out the bumps along the way. And then you've got value investing.
Value investing. Okay, that's another one we hear a lot about.
With value investing, you're looking for stocks that the market might be undervaluing. Companies that have strong fundamentals, like good revenues, solid profits, a strong competitive edge, but for whatever reason, the market hasn't caught on yet.
So, like hitting gems, companies that are being overlooked.
Kind of, yeah. It takes a lot of research to find these opportunities, but if you get it right, if you find a truly solid company trading at a discount, the returns can be fantastic.
The rewards can be worth it, though.
Exactly.
Okay, so we've got Belfort's pump and dump on one side, and then these legitimate ethical strategies on the other. Just to wrap things up, can we break down the key differences? Give our listeners a clear picture of what we're talking about.
Absolutely. When you compare Belfort's schemes to these ethical strategies, the differences are, well, huge. I mean, first off, legality. Belfort's methods, criminal, illegal. You do that, you're going to jail. But the strategies we've talked about, they're all perfectly legal by the book. And then there's risk. Pump and dumps are super risky, legally and financially. You could lose everything. But ethical strategies, especially if you diversify, the risks are much more manageable. And then you got the time horizon. Belfort's approach was all about making a quick buck fast. But ethical strategies, they're about building wealth over the long term. Slow and steady wins the race, right?
Right.
And maybe most importantly, Belfort's schemes actually hurt people. He was stealing from everyday investors. But ethical investing, it's the opposite. You're supporting good companies, helping to stabilize the market. It benefits everyone in the long run. And finally, pump and dumps, they just don't last. Regulators are going to catch on and the whole thing will come crashing down. But ethical strategies, they're sustainable, they're aligned with long-term market trends, they're the real deal.
It's pretty clear then. The Wolf of Wall Street is a fun movie, sure, but the way Belfort got rich, that's not going to fly in 2025. It's illegal, it's risky, and it just doesn't work.
Wow.
If you want to build real lasting wealth, you got to focus on the ethical strategies.
I couldn't have said it better myself. And it raises a really interesting question. As technology keeps evolving and the financial world keeps changing, what new kinds of scams will pop up? What creative ways will people come up with to try and cheat the system? And how can you, as an investor, stay ahead of the game? How can you protect yourself?
That's a really good question. Something for all of us to think about, for sure. But for now, just remember, building wealth the right way. It's a marathon, not a sprint. No shortcuts. You gotta be patient, stick to the rules, and focus on the long term. Do that, and you'll be on the right track to reach your financial goals.
Thanks for joining us on this deep dive, everyone.
My pleasure. It was great being here.
See you next time.